In the shadowy high-stakes world of cryptocurrency, fortunes are made and lost in the blink of an eye. This is a world built on code, trust, and audacious promises. But what happens when the code is flawed, the trust is shattered, and the promises turn to dust? This is the story of a self-proclaimed genius, an algorithmic dream, and a $60 billion collapse that triggered a global manhunt. This is the story of Terra Luna. At the center of our story is Do Kwon, a charismatic and brash Stanford-educated computer scientist. He was the face of Terraform Labs, the company behind a revolutionary crypto project. To his followers, he was a visionary, a maverick who was building the future of decentralized finance. He cultivated an almost cult-like following on Twitter, where he taunted critics, dismissed concerns with arrogant quips, and famously declared that 95% of other crypto projects would die. But that watching them die is entertaining? He projected an aura of unshakable confidence. A man who had cracked a code no one else could. His magnum opus was an ambitious two-token system, Terra USD, or used, and its sister coin. Luna Use was an algorithmic stablecoin. Unlike other stablecoins like Tether or USDC, which are supposedly backed by real-world assets like dollars or bonds, UST maintained its peg to the US dollar through a complex algorithmic relationship with Luna. The concept was elegant, almost magical. If UST's price dipped below $1, the algorithm would allow traders to burn UST to mint $1 worth of Luna, profiting from the arbitrage and pushing the UST price back up. Conversely, if UST went above $1, they could burn Luna to create more UST, bringing the price back down. The entire system was a delicate, automated balancing act, with Luna acting as the shock absorber. To supercharge this ecosystem, Do Kwon created the Anchor Protocol, a decentralized bank that offered an unprecedented, almost unbelievable 20% annual yield on used deposits. It was an offer too good to refuse, and billions of dollars poured in from investors. From seasoned crypto veterans to everyday people dreaming of financial freedom. The algorithmic dream was in full swing, and Do Kwon was its conductor. Then, in the early days of May 2022, the music stopped. The death spiral, a catastrophic scenario that critics had warned about but Do Kwon had arrogantly dismissed, began. It started with massive, coordinated withdrawals from the Anchor Protocol and huge sell orders of UST on various exchanges. The delicate algorithm was suddenly under immense pressure. As UST's price started to slip from its $1 peg, panic set in. The system was designed for people to burn UST and mint Luna to restore the peg, but the selling pressure on UST was too immense. As more and more Luna was minted to absorb the falling UST, the supply of Luna ballooned into the trillions, causing its own price to crater. It was a bank run in hyperspeed, executed on the blockchain. The core promise of UST that it would always be redeemable for $1 worth of Luna was broken. UST was worth 50 cents and you burned it, you were now minting $1 worth of a rapidly depreciating asset. The arbitrage mechanism that was supposed to save the system was now accelerating its demise. Within 48 hours, the price of Luna, which had been trading near $100 just a month earlier, plunged 2 fractions of a cent. Used, the stablecoin, bottomed out at less than 10 cents. The algorithmic dream had imploded, and $60 billion in market value was vaporized. The fallout was immediate and brutal. Countless investors who had poured their life savings into what they believed was a safe, high-yield investment were wiped out. The stories were heartbreaking. Retirement funds gone, college savings vanished, lives turned upside down. Shockwaves didn't stop with Terra. The crash created a brutal contagion effect across the entire crypto market. Major crypto hedge fund, 3 Arrows Capital, or 3AC, which had a massive exposure to Luna, became insolvent and collapsed. This, in turn, brought down crypto lenders like Celsius and Voyager, who had lent vast sums to 3AC. It was a chain reaction of financial devastation, all sparked by the failure of Do Kwon's grand experiment. And as his empire crumbled, Do Kwon, the once arrogant king of crypto, vanished. He became a fugitive, with Interpol issuing a red notice for his arrest, and authorities from South Korea to the United States launching an international manhunt. From a forensic finance perspective, understanding this collapse requires tracing the flow of money. Investigators are meticulously piecing together the blockchain data. Following the digital breadcrumbs between anonymous wallets and massive cryptocurrency exchanges, they were looking for evidence of market manipulation. Did a specific entity launch a coordinated attack to depeg UST for profit? They were also tracing funds moved by Do Kwon and Terraform Labs in the months leading up to the crash. Reports suggest that billions of dollars were moved through a web of shell companies and offshore accounts, raising questions about whether the collapse was simply a flawed design or something far more sinister. Was the system built to fail, allowing insiders to cash out before the inevitable implosion? Every transaction on the blockchain is a permanent record, a piece of the puzzle that prosecutors are now using to build their case. The psychological dimension of this saga is equally telling. Do Kwon embodied the fake-it-till-you-make-it ethos, amplified by the echo chamber of social media. He wasn't just selling a technology, he was selling a belief, a cult of personality. Investors weren't just buying a coin. They were buying into the idea of a financial messiah who could deliver them from the old world of finance. This blind faith, fueled by the promise of impossibly high returns, created a massive bubble. The critical mistake in risk management was the complete misunderstanding of the foundation of the asset. Investors treated UST as if it were as safe as cash in a bank, lured by the 20% yield from the Anchor protocol. They failed to see that this yield was an unsustainable marketing gimmick, funded by venture capital money to bootstrap the ecosystem. They ignored the fundamental risk. The entire $60 billion empire was built on a single, unproven algorithmic theory. When trust in that algorithm faltered, there was nothing left. The only real asset backing the system was faith in Do Kwon, and when the code broke, that faith evaporated instantly. The lesson from the Terra Luna catastrophe is a harsh one, a timeless warning wrapped in 21st century technology. It teaches us that in any investment, especially in a volatile and unregulated space like cryptocurrency, you must look past the charisma and the hype. You must question everything, especially promises that seem too good to be true. The core principle to remember is that when trust in a founder or an algorithm is the only asset backing your investment, you aren't an investor, you're a gambler. And as the ruins of the Terra ecosystem show, sometimes the house is designed to collapse on top of everyone inside. Always do your own research. Understand the fundamental risks behind the yield, and never ever invest more than you can afford to lose. Because in the digital Wild West, the line between a visionary and a fugitive can be perilously thin.